Welcome to an in-depth, yet simple, explanation of one of the most foundational concepts in modern finance, fractional reserve banking. We are starting with a big, philosophical question that most people get wrong. Where does the money in your wallet or in your bank account actually originate? Seriously, where does all the money in the economy actually come from? We all interact with it every day, but few understand its true origin. If you said it comes from the government printing press, you're only partially correct. Yes, the government prints the physical cash, but that is only a small piece of the puzzle. The truth is, most of the money circulating in the economy today is created not by the government, but by commercial banks through the simple act of lending. To understand how this happens, let's simplify things with a small town scenario featuring Alice, Bob, and one local bank. Our story begins with Alice. She earns $100 and deposits it safely into her local bank account. At this point, the total money supply is just that original $100. The bank can't just lend out all of Alice's money. Regulations require them to keep a fraction, let's say 10%, in reserve. That means $10 is locked away in the vault, ready for Alice if she needs to withdraw a small amount. The remaining $90 is considered excess reserve. The bank now loans this $90 to Bob, who needs it to buy a new bicycle. Crucially, the $90 Bob now holds is asterisk new money added to the supply. This is where the magic of fractional reserve banking truly happens. The process doesn't stop after the first loan. It multiplies. Bob takes his $90 and buys the bike from Charlie. Charlie doesn't want to keep that cash under his mattress, so he deposits the entire $90 back into the very same bank. The bank repeats the process. 10% of Charlie's $90 deposit, which is $9, is kept in reserve. The remaining $81 is now available to be loaned out again, further expanding the money supply. This cycle can repeat itself theoretically forever, but the amounts get smaller each time. With every loan, new money is created, leading the total money supply to be much larger than Alice's original $100 deposit. Now that we know how money is created, let's address the potential risk that comes with this system and how modern economies manage it. If the bank only keeps 10% of the money on hand, what happens if Alice, Charlie, and everyone else who deposited money decides they want all their cash back at the same time? If too many people try to withdraw their deposit simultaneously, it leads to a financial panic known as a, quote, bank run. The bank simply doesn't have enough physical cash to meet everyone's demand. To prevent these panics, modern systems employ two main safety nets: central banks, which can lend cash to banks in crisis, and deposit insurance like the FDIC, which guarantees your money even if the bank fails. Let's summarize what we've learned and connect fractional reserve banking to the bigger picture of the global economy. Remember, fractional reserve banking means banks only keep a fraction of deposits and lend out the rest, which fundamentally expands the money supply far beyond the initial deposits. Understanding this mechanism is key to grasping inflation, interest rates, and the true power that banks and central banks hold over the entire financial landscape.